Hey guys, I'm Luke, a CFA Charterholder. Today we're going to be discussing one of the topics in the corporate issuers section of the level 1 material, which is tax. So when you think about different organisational forms, you've got sole proprietorships, partnerships, corporations, and they generally follow two different types of tax structure. So you've got your pass-through taxation, which is what pretty much all of them follow. Sole proprietorships, partnerships, and private limited companies all employ and follow a pass-through taxation model, whereas public limited companies follow a slightly different model, and that is double taxation. So we'll get into what the two different types of tax models are, why they're important. We'll do a calculation to illustrate how they differ. Let's get into it. Okay, so as I alluded to in the introduction, the profits that public limited companies generate are subject to two layers of tax. Firstly, let's think about the tax that the company pays. So the company will pay corporate income tax on the profits that they generate. So that makes sense. The company is generating profits and they pay corporation tax on those profits. So that's at the company level. Before anything is paid out to shareholders or any investors, the company needs to pay corporate income taxes. And the tax that they pay is on profit known as taxable profits. And taxable profits, to be clear, are not the same as accounting profits. So when you look at an accounting profit in an income statement or in an annual report that the company publishes, that profit is different to taxable profit. And that's because there's different expenses that you can deduct from your accounting profit that you can't deduct from your taxable profit, and many other nuances that we won't go into in this video. But yeah, taxable profit is not quite the same as accounting profit that companies report in their financial statements. And this is because the standards differ. So tax reporting and financial reporting standards differ. And yeah, some expenses are deductible for tax purposes, while others are not. Public limited companies are able to distribute their profits to shareholders. And what makes double taxation differ to pass-through taxation is that two layers of tax need to be paid. So this is kind of obvious as the name suggests it, but I want to be clear on what these two layers of tax are. So first is the tax that we mentioned above, so the tax on company profits. So a company generates revenue, it pays its operating expenses, it pays off its interest on its debt, and then that residual profit is taxed. And the company bears this tax. They have to pay this tax based on their local corporate income tax rate. And then those profits, once they've been taxed, those profits can be distributed to shareholders as a dividend. And this is where the second layer of tax comes in. So the tax that is paid out to the shareholders is taxed at the shareholders' personal income tax rate. Companies generate profit, they either retain or distribute that profit to shareholders as a dividend. Whatever they do decide to distribute to shareholders as a dividend is taxed at the shareholder personal income tax rates. So that contrasts to pass-through taxation, because pass-through taxation involves one layer of tax. The business in a pass-through taxation structure pays no corporate income tax. So we'll look at an illustration on the next page to make it crystal clear how this all works. So let's look at the public limited company first. Public limited company generates sales, which create revenue. These sales create a profit for the business. So the business is generating a profit, and then the business will dividend some or all of that profit out to the owners, so the shareholders in the business. And as we discussed, there's two layers of tax. So the profit that the business generates is taxed at the company's corporate income tax rate, and the dividends are taxed at the shareholders' personal income tax. So in effect, two layers of tax, which is obviously not a good thing. Public limited companies incur two layers of tax, which is not ideal. Whereas all other business structures we look at in the curriculum, so this is not just private limited companies, this is partnerships, so general partnerships, limited partnerships, limited liability partnerships, sole proprietorships. All these business structures follow pass-through taxation. Sales are generated, profits are distributed out to the owners. We follow the exact same sort of business model as the public limited company. And the dividends are taxed, i.e. the distributions out of the profit are taxed, again, at the personal income tax rate of the owner. But the crucial difference under a pass-through taxation structure is that the business profit is not taxed. There's no corporate income tax. There's no such thing as sort of business tax for sole proprietorships, partnerships, etc. So no tax is due. This is known as the pass-through taxation model. And then the public limited companies follow the double taxation. So that's a quick contrast. Let's do an example. This is a double taxation for a public limited company example that you may get in an exam. So an automobile manufacturer generated 290 million of pre-tax profit in the last financial year. So 290 million of profit before any tax is paid by the company. The company pays 51 million of corporate income tax on those profits, and the company decides to distribute all of its after-tax profits to shareholders as a dividend. So 100% of those post-tax profits are distributed out to shareholders as a dividend, and those dividends are subject to a 25% tax rate. So the personal income tax rate on the owners is 25%. So here's the question. Assuming the firm is structured as a public limited company, determine the value of the income received by the shareholders after all relevant taxes have been paid, as well as determine the total tax rate as a percentage of the company's pre-tax income. So there's two things we need to determine: the post-tax proceeds that the shareholders receive after all tax has been paid off. So what do the shareholders actually receive in their pocket? And then what is the total tax rate as a percentage of the company's pre-tax income? Okay, we've got a public limited company. We know that public limited companies are taxed twice, at the company level and the shareholder level. So we discussed that on previous slides. We know there's going to be two taxes due here on that 290 million worth of profit. So starting at the first level, the company level. The company pays 51 million of corporate income tax. That's how much tax the company pays. So after the company has paid its corporate income tax, there will be 239 million of cash available to distribute to the shareholders. We know that 100% of the post-tax corporate profits will be available to be distributed to shareholders as a dividend. So that's 239 million of cash that's available. And we know that at the shareholder level, the tax rate equals 25%. So that's the dividend tax that needs to be paid by the shareholders. So the tax by shareholders equals 25% times 239 million equals 59.75. So that's how much tax the shareholders pay. So once all shareholders have been paid, the cash available to shareholders after all tax paid equals 239 million minus 59.75 million, which equals 179.25 million. So that is how much cash is distributed to the shareholders after all taxes have been paid. So that's part one of our question. Part two, what's the blended or total tax rate as a percentage of the company's pre-tax income? So the tax rate is equal to all the tax that's been paid. So that is 59.75 million, which is the shareholder tax that's paid on the dividends, plus the 51 million paid by the company. That's the corporate income tax that's due. And we calculate that as a function of the 290 million. Because that's what the question is asking for, right? What is the percentage of total tax paid as a function of the company's pre-tax income? So the 59 million plus the 51 million over the 290 million of pre-tax corporate earnings. And that equals 38.5%. 28.2%. So that's the total tax rate, the total tax as a percentage of the pre-tax corporate profits. So just to finish off here, this example shows the main downside of structuring your company as a public limited company. There's two layers of tax. You've got your corporate income tax plus your dividend tax. So if you're a shareholder in a public limited company, that's a downside you need to be aware of. However, while theoretically the same earning stream can be taxed twice for a public limited company, at the company level and the shareholder level, what is important to be aware of is that the management team do have control over the amount of shareholder level tax that can be realised. So managers have control over how much tax shareholders pay. So why is this? So the corporate company profits are always taxed in full at the company level. So you always have to pay, if you're a company, you're a public limited company, you always have to pay your corporate income tax. You can never get away from that. But managers and companies have discretion over whether they pay out a dividend, and therefore whether shareholder level tax is due. Managers can decide to pay out a dividend. The downside of doing that is that it will incur a tax for the shareholders, or they can decide to retain and reinvest the profits within the company, which means they don't pay a dividend, and therefore no income tax is due for the shareholder. So just because there's two layers of tax that exist within a public limited company structure does not necessarily mean that two layers of tax need to be incurred. Managers can potentially restrict dividend payouts to prevent two layers of tax. Just finishing off, going back to pass-through taxation, sole traders, partnerships do not have the option to retain their earnings or pay them out as a dividend. This is because the tax treatment means that all business profits are taxed at the owner's personal income tax rate, whether they decide to reinvest the profits or not. And personal income tax rates are often much higher than corporation tax rates. So companies can be an appropriate structure and more tax efficient when the objective is to reinvest profits, grow the company, and pay small to no dividends. So if you want to create a company that's reinvesting its profits and not paying anything out, then public limited company structures would be the preferred route. Whereas if you are looking to pay out your earnings to owners, then public limited companies may not be the optimal structure. So yeah, that's everything I wanted to discuss in this video. Hopefully that was helpful. Hopefully that all made sense. Any questions, feel free to fire them off in the comments. And I'll see you guys in the next video.